In 1998, a hedge fund called Long-Term Capital Management came within hours of triggering a global financial crisis. The fund had been founded by some of the most credentialed financial minds in the world. Its partners included two Nobel Prize winners in economics, Myron Scholes and Robert Merton, whose work on options pricing had fundamentally changed how financial markets understood risk. It included former senior traders from Salomon Brothers, one of the most sophisticated bond trading firms on Wall Street. It included academics whose mathematical models of financial markets were considered state-of-the-art by every measure available at the time. The fund's strategy was built on the mathematical certainty, as its founders understood it, that certain price relationships between financial instruments would converge over time toward their theoretical values. The model said so, the historical data said so, the Nobel Prize winning theory said so, and for the first several years of the fund's operation, the markets agreed. Long-term capital management generated returns that validated the strategy and the models and the extraordinary intellectual firepower that had constructed them. And then the models were wrong. The Russian government defaulted on its debt in August of 1998, producing market dislocations that the models had assigned a probability so low as to be effectively impossible. The price relationships that the model said would converge instead diverged. Dramatically, persistently, in ways that the mathematical framework said could not happen. The fund lost $4 billion in 4 months. Its positions were so large and so leveraged that the prospect of a disorderly liquidation threatened to cascade through global financial markets in ways that the Federal Reserve considered serious enough to coordinate an emergency bailout by the fund's creditors. The most mathematically sophisticated investors in the world, armed with Nobel Prize-winning theory and decades of combined experience, had built a fund that nearly destroyed the global financial system because the models they trusted with absolute confidence were incomplete descriptions of how markets actually behave under stress. The intelligence that constructed the models was genuine. The credentials were real. The mathematical rigor was extraordinary. And the outcome was catastrophic because intelligence, credentials, and mathematical rigor are not the same thing as good financial judgment, and in some ways, they actively undermine it. This is the paradox at the center of one of the most important and least discussed findings in behavioral finance. The characteristics that we associate with the kind of intelligence that should produce superior financial decision-making, analytical sophistication, quantitative ability, high confidence in one's own reasoning, the ability to construct complex models and follow them to their logical conclusions, are frequently the same characteristics that produce the most catastrophic financial errors. Not despite the intelligence, because of it. Understanding why this is true and what it means for your own financial decision-making is the subject of this conversation. Let us start with the research, because the research is counterintuitive enough that hearing the conclusion without the evidence is likely to produce skepticism rather than recalibration. A study conducted by researchers at the University of Chicago examined the investment returns generated by a large sample of individual investors over a multi-year period, and compared those returns against several measures of cognitive sophistication, including education level, professional occupation, and scores on standardized measures of analytical ability. The finding that surprised the researchers and has continued to generate debate in the behavioral finance literature is that higher cognitive sophistication was associated with higher trading frequency, but not with higher returns. The more analytically sophisticated investors traded more often, constructed more elaborate rationales for their trading decisions, and generated returns that were no better, and in many cases worse, than the returns generated by less sophisticated investors who traded less frequently. A separate study examining the investment behavior of finance professionals compared to non-finance professional investors found that the finance professionals were significantly more likely to engage in behaviors that the behavioral finance literature has consistently associated with lower returns. They were more likely to trade actively rather than passively. They were more likely to believe that their analysis of individual securities could produce returns above the market average. They were more likely to be overconfident in the accuracy of their own forecasts. And their actual investment returns, when measured against appropriate benchmarks, were not superior to the returns generated by simple, passive index fund strategies that required no analysis whatsoever. The explanation for this paradox is not that intelligent people are secretly bad at math or bad at analysis. The explanation is that financial markets are not primarily an analytical problem, they are a behavioral problem. And the cognitive characteristics that produce analytical sophistication frequently exacerbate the behavioral vulnerabilities that destroy investment returns rather than mitigating them. Here's the first mechanism. Having overconfidence scales with intelligence and expertise in ways that are directly harmful to investment outcomes. Research on overconfidence in forecasting has consistently found that the accuracy of predictions does not scale proportionally with the confidence that the predictor places in those predictions. Experts in a field are more confident in their forecasts than non-experts, as you would expect given their greater knowledge and experience. But the gap between their confidence and their actual accuracy is also larger than the corresponding gap for non-experts. The expert's confidence grows faster than their accuracy. This means that in domains where uncertainty is high and the future is genuinely unpredictable, which describes financial markets almost perfectly, expertise produces higher confidence without producing proportionally higher accuracy. For an investor, this means that the more sophisticated your analysis of a potential investment, the more confident you become in your forecast of its future performance, and the more aggressively you are likely to act on that forecast. The confidence is a product of the analytical process. The accuracy of the underlying forecast is a product of whether the future actually unfolds as the analysis predicted. In financial markets, where the future is shaped by millions of interacting human decisions and unpredictable external events, the accuracy of the forecast is frequently much lower than the confidence in it. The sophisticated investor who has done extensive analysis and reached a high conviction conclusion is systematically more likely to be confidently wrong than to be right in the specific way they were confident about. The second mechanism is what researchers call the narrative fallacy, and it operates with particular force on analytically sophisticated minds. Human beings are story-building creatures. When we encounter a set of facts or data points, our brains automatically and unconsciously construct a narrative that connects them into a coherent story with causes and effects and a logical progression. This narrative construction happens faster than conscious reasoning and is largely invisible to us. We experience the narrative as an insight or a conclusion rather than as a story we have constructed, which makes it feel like an objective perception of reality rather than an interpretive framework we've imposed on the data. In financial markets, the narrative fallacy produces investors who look at a set of facts about a company or an asset, construct a compelling story about why those facts imply a particular future outcome, and then mistake the compellingness of the story for evidence of the accuracy of the prediction. The story feels right. It is internally consistent. It accounts for the relevant facts in a satisfying way. And none of that has any necessary relationship to whether the predicted outcome will actually occur. The analytically sophisticated investor is more vulnerable to the narrative fallacy, not less, because they have a larger toolkit for constructing compelling narratives. The non-expert looks at a company and thinks it seems like a good business. The expert looks at the same company and constructs a detailed narrative about competitive moats, industry dynamics, management quality, balance sheet structure, and valuation that feels far more grounded in reality. Both the simple impression and the sophisticated narrative may be equally poor predictors of future stock performance. But the sophisticated narrative feels much more like analysis and much less like a story, which makes it much harder for the analytically sophisticated investor to maintain the epistemic humility that good investment decision-making requires. The third mechanism is the optimization trap. Analytical sophistication produces a strong drive toward optimization, toward finding the best possible option given the available information and constraints. In many domains, this drive toward optimization produces genuinely better outcomes. Engineering, medicine, logistics, and many other fields reward the effort to find the optimal solution to a well-defined problem. Financial markets are not a well-defined optimization problem. They are a complex adaptive system in which the act of identifying and pursuing an apparent optimization opportunity changes the system in ways that frequently eliminate the opportunity. If a true pricing anomaly exists in financial markets, meaning a situation where an asset is genuinely mispriced relative to its fundamental value, the existence of that anomaly will attract capital from sophisticated investors seeking to exploit it, which will drive the price toward its fundamental value and eliminate the opportunity. The market is constantly processing the analytical efforts of millions of sophisticated participants and incorporating their conclusions into prices. The opportunities that remain after this processing are the ones that are either too small to attract significant capital or too uncertain to be confidently identified and exploited. The analytically sophisticated investor who spends significant time and energy searching for these opportunities is engaged in a competition against every other sophisticated participant with the same information and similar analytical tools. The expected return from winning this competition is modest. The expected cost of the effort, measured in time, attention, and the trading cost generated by acting on the conclusions, is not modest. The simple passive strategy of owning the market at low cost, which requires no analytical sophistication whatsoever, has outperformed the majority of active strategies run by professional investors over virtually every meaningful time horizon. This is perhaps the most counterintuitive finding in all of financial economics, and also one of the most consistently replicated. Over 10-year periods, approximately 80 to 90% of actively managed mutual funds underperform simple passive index funds in the same asset class after fees. Over 20-year periods, the percentage of active funds that underperform is even higher. The professional investors running those active funds are not unintelligent. They are not analytically unsophisticated. They are applying genuine expertise and considerable resources to the task of identifying investments that will outperform. And the majority of them, over the long run, fail to do so. The fourth mechanism is loss aversion amplification through sophisticated rationalization. Loss aversion, which is the tendency to feel the pain of losses more intensely than the pleasure of equivalent gains, is a universal human characteristic documented across cultures and income levels. For most investors, loss aversion manifests as the reluctance to sell a losing investment because selling crystallizes the loss and forces an emotional confrontation with having been wrong. The stock that was purchased at $50 and is now worth $30 is held rather than sold because selling means acknowledging and internalizing the $20 loss in a way that continuing to hold the stock does not. For the analytically sophisticated investor, loss aversion is frequently amplified by the ability to construct sophisticated rationales for continued holding. The non-sophisticated investor holds the losing stock because they cannot bring themselves to sell it. The sophisticated investor holds the losing stock and simultaneously constructs a detailed analytical case for why the original thesis is still intact, why the current price represents a temporary dislocation rather than a permanent revaluation, and why the rational course of action is to hold or even add to the position. The sophistication of the rationalization makes the emotionally motivated decision feel like an analytically grounded one, which makes it far more resistant to the kind of honest self-examination that would expose it for what it actually is. So, what does all of this mean for how you should approach your own investment decisions? The first implication is that simplicity is not a consolation prize for investors who lack the sophistication to do something more complex. It is frequently the optimal strategy available. A portfolio of low-cost, broadly diversified index funds that is contributed to consistently and not traded based on market conditions or analytical conclusions about individual securities will outperform the majority of more sophisticated investment approaches over meaningful time horizons. This is not because the sophisticated approaches are unintelligent. It is because the market is sufficiently efficient that the edge from sophisticated analysis is smaller than the cost generated by pursuing it. The second implication is that the most important investment skill is not analytical at all. It is behavioral. The investor who does nothing during market downturns, who continues contributing to their index funds when prices are falling and the narrative environment is most alarming, who does not attempt to time the market based on economic forecasts or political events, and who does not chase the performance of whatever asset class or strategy has produced the best recent returns, will outperform the majority of more analytically active investors, not because they are smarter, because they are not allowing their intelligence and emotional reactions to interfere with a simple process that works when left alone. The third implication is about how to use analytical sophistication constructively in financial decision-making. The domain where analytical sophistication genuinely helps is not security selection or market timing, where the evidence for its value is weak. It is in the structural decisions that determine the efficiency of your financial life. Understanding the tax implications of different account structures and optimizing your use of them. Understanding the fee structures of the financial products you hold and minimizing them. Understanding the insurance coverage you need and ensuring you have it at the right cost. Understanding the terms of your debt obligations and managing them intelligently. These structural decisions, where analysis of specific knowable information produces actionable conclusions that are not immediately competed away by other sophisticated participants, are the places where intelligence and analytical sophistication genuinely improve financial outcomes. The smartest investors in the room are frequently the worst performers in the room, because the room is a financial market, and financial markets are primarily a behavioral arena rather than an analytical one. Understanding this is not a reason to abandon analytical thinking. It is a reason to deploy analytical thinking where it actually produces results, and to replace it with simplicity and behavioral discipline in the places where analytical sophistication reliably produces worse outcomes than doing nothing. Next week on Quiet Rich, I'm covering the corporate disaster that lost $4 billion because of a single email, and what the story reveals about the catastrophic cost of poor communication and inadequate institutional risk management at the highest levels of global finance.